Hello and welcome very much to another Securities Lending Live with Pierpoint. I'm Roy Zimmerhansl and I have the pleasure of being your host today. Look, welcome back. This has been a long break. We haven't done one of these since the end of February when we talked about GameStop, surprisingly enough. But unfortunately, I've had what I think they call on the public airways cerveza sickness. In order to avoid any kind of conflicts. Look, the objective of these events is to discuss relevant topics in securities finance, so securities lending, collateral management, repo, and related areas like short selling and HQLA activity. So by definition, these events are live, and so they're open to anyone on LinkedIn, and we genuinely want you to put your comments, questions, and suggestions into the comments. And although this is live, you also have the opportunity to review it on replay and put comments in there. So if you miss a Wednesday event, don't worry, it'll be available again. Obviously, it's better if you're live because you can ask questions and make comments and share your input with us. Look, just a quick point. When you put a comment in, we'll pick them up, but there is a delay of about sort of 20 or 30 seconds for you putting something in and me being able to see the screen. Now, I have the pleasure of being host and also producer. So if you see my eyes darting off in different directions, that's because I'm looking at different monitors and screens and questions. So it's not because I don't love you, because I genuinely love everyone that's tuned in. I'm going to ask all the panelists to introduce themselves in a minute. But first, look, I have a question which we always ask. Where are you watching from? We've had quite a diverse group of people. I think we haven't had anyone from New Zealand, but we've had watchers from Australia and many of the Asian countries. And we actually had a friend of mine dialed in one day at 5:30 a.m. from Boston, which I thought was a yeoman effort, particularly because they're not in securities finance. So first, let me introduce our special guest, someone who has been part of the securities finance markets for decades and decades, and someone who I've known even longer than that, Mr. Paul Wilson from Markit. Paul, over to you. Please introduce yourself.
Yes, good morning, Roy. Good morning, John. Yes, Paul Wilson from IHS Markit. I look after the securities finance business here. And as you said, Roy, been in the securities finance industry more years than I care to recall. And of course, our distant past goes back to probably the early 80s when we first met at the small bank that was Chase Manhattan.
Yes, where you were the derivatives operations and valuation guru at the time. You're the most knowledgeable person in the market in the world, possibly at that point.
Oh, Roy, you say all the nice things.
Okay, thanks very much. We'll be back to you in a minute, Paul. Now my esteemed partner, Mr. John Arnesen, over to you.
Morning. Good morning to people who are dialed in. Strangely enough, Roy, after your comment about someone dialing in from New Zealand, someone just did. So good evening to Elena. John Arnesen, I'm the consultancy leader for Pierpoint. In my previous life, prior to joining Pierpoint, I ran various agency lending businesses for a number of banks over my 30 odd years in the industry.
Right. Thanks very much, John. So as I said, what we're going to be talking about today is whether there's going to be any potential negative feedback or impact on securities lending or short selling for either the established markets where it's going on today or potentially emerging markets where it's developing or still yet to come. So we'll be talking about that. And if you have any questions or comments, that would be particularly welcome. But maybe, John, maybe we can start because it's always been quite surprising, I think, for many people that post the global financial crisis in 2008, many new countries have actually introduced short selling securities lending, which seems to be kind of counterintuitive.
It does in some ways. And it's interesting when you think about, when you go back to the years following the financial crisis or the global credit crisis, whichever you want to call it. Short selling was blamed for a lot of the demise in share price at the time, but subsequently it proved not to be the case. Through academic research, it pretty much established that it found that there was no evidence for that. And on the contrary, it also established that in the absence, it can affect liquidity and bid-offer spreads, etc. More importantly, which I think we've experienced this year in particular, in that it can also uncover and punish badly run companies. Now, despite that, I did a little bit of research, and it's interesting to note that short selling isn't introduced in an unfettered way that we may experience here in the West and in developed markets. It tends to evolve slowly and is introduced with some purpose. And the driving force for that typically is when you have an emerging market that's, say, considered by the MSCI as a frontier market, but it's moving its status up to emerging market status. And when that happens in anticipation for entry to the MSCI World Index, the ability to short sell is paramount in these markets' development, and therefore they tend to look at it early on in their development of their markets. And a good example is actually what's going on in the Gulf states. The Gulf states, actually, Qatar and the UAE introduced the concept in 2017, but it's still a kind of developmental agenda item. And mostly the issue that they're but the issue they're facing is that large parts of their market are driven by retail investors. And there is an overwhelming desire to protect retail investors, perhaps from themselves to some extent. I mean, in both the examples I just used, 70% of the market or the liquidity comes from retail. And therefore, they're going to be somewhat cautious in their introduction. The second element that they have to face is is it compatible with Sharia law? Now, Saudi Arabia, that you probably read earlier this year that there's been successful transactions on the Saudi exchange, which is testament to the fact that they took a very measured approach to this as well. But they had to get over this issue in Sharia law, which is hadith, which means you cannot sell something that you do not own. And through various debate, scholarly interpretation, they got over that issue, and therefore they have, in fact, as of the 25th of March, introduced the ability to short sell for retail for investors on the exchange and for all foreigners. But there are some restrictions, as you'd expect there to be. So no more than 10% of any free float can be shorted. In the emerging markets, you do find that there are prescriptive habits which you have to adhere to, unlike maybe we experience with some of the markets that were typically used in Europe. But it is, as you say, Roy, it shows that actually, if they're going to develop markets well, it comes in stages. A second stage will be the introduction of derivatives or futures. Short selling is in that suite of products that have to be introduced in order for the market to operate functionally. And that, to me, is enough to tell you that despite the vilification at times from maybe those that don't have all the information they need of short sellers, the fact is that it's kind of vital if you're going to introduce a market that develops deep liquidity. So that's kind of where the emerging markets are in terms of their development. Vietnam's another good example where they've been arguing about this since 2014. It's the third largest economy in Southeast Asia. It's growing like crazy. So they are now, in the throes of really working out how they're going to introduce this. So the good news is that markets around the world recognize that it's a necessity, that it is absolutely part of the suite of products they need to offer on an exchange. There are some gaps, I think. I think India has a gap internationally where foreign investors cannot do what they can do domestically, which is quite lengthy and difficult to achieve. But eventually they'll get there. So on that note, if you have any questions, that's kind of where we are. I can't. You're on mute, Roy.
Thanks. There you go. As I said to Paul in the pre-chat, live streaming is just so much fun. not sometimes. People that watch us at the Christmas event will remember the escapades there. But listen, Paul, John, that was pretty good sort of ground setting, and I think you've given us sort of 5 or 6 things to talk about. Before I hand over to Paul, I just want to say, as you said, Alina has dialed in from New Zealand. And listen, Alina, thanks very much. She's been very engaged with many of the blog posts that we put up recently. So much appreciated. Also, hello to Cedric from Hong Kong, Rob Nunn holding the fort for the British side and supporting colleague Paul from Hornchurch, Drew. Again, insightful comments. We've had some exchanges on Twitter this morning about short selling GameStop and the U.S. Congressional inquiries. And John Rasmussen, thanks again for watching. But Paul, I think John really gave us a great sort of fundamental sort of background to this. What are your thoughts? Paul? Oh, either he...
Look, first of all, that was a great...
You froze. Now we can hear you again. Thanks. Go ahead, Paul. Oh.
Yeah. Okay. Look, I think the first thing is that... Can you hear me, Roy?
Yeah, Paul, what I suggest you do is maybe undo your video because it's showing challenged broadband. So why don't you turn your video off and just talk to us?
Okay. Yeah, hopefully that's better. Yeah, welcome to England in 2021, where the internet just doesn't seem to work. So good summary from John. I think back over the last 10, 12 years, and any time there is a market event, it does seem that short sellers, securities lending seems to get dragged into the debate. It's rare that they get dragged into the debate in a positive way. Although I have to say, and I was trying to rack my brain on this morning, even though there's been a lot of noise around what we now know as the GameStop affair, it doesn't seem so as intense as it was perhaps in prior events. But John touched on some of the things. I think it's somewhat well understood, but sometimes often ignored, the value that short selling or the ability to borrow securities has on the market. John touched on liquidity. So the availability of additional securities does allow investors of all shapes and sizes and of different views to be able to transact. Pretty much most of the time. In terms of market efficiencies, borrowing the security for a short period of time can clear up potential failed trades, and as importantly, allows investors to all of them to express their views and opinions around a company. And it's interesting that if we think about one of the other events which I'm sure everybody's talked about around Wirecard. I mean, the short sellers probably should be congratulated for uncovering what was a horrendous fraud. So there are lots of positives that come out of it, which I said in these events tend to get ignored.
Yeah, thanks for that. And I think you've made some great points here. So if we just unpack that, I mean, John, you talked about Vietnam as an example, and they've been looking at this for many years. And the point Paul just made is really the bedrock of where securities lending actually started to become most frequently used, which was fail resolution. And that really is still the backbone. But a question, I guess, for people is, in terms of running it as a business, how much impact do you think that kind of the fail coverage has had, and did that change when we shortened settlement timeframes? Your turn to be on mute. I think we'll just take turns doing that.
So I was going to say that back in the Jurassic period, Roy, when you started in securities lending, fail coverage, particularly in the US, where this whole thing probably, was born out of to some extent. I remember being in New York in my early days, and colleagues referring to the cage. And I thought, what the hell's the cage? And what they were referring to was the physical. It was an area like a prison cell where you physically reconciled share certificates. And from that, when it went to dematerialize electronic transformation, transition of securities, it gave rise to far more failed transactions. And I think that was the catalyst for introducing the concept, because it was actually a very sensible thing to do. We can't gum up the system with failed transactions. Therefore, if someone's willing to let them, so be it. I think with the efficiency that we've had through technology over the years, I think that is probably representing a modest percentage of the activity that goes on today. But if you ask Euroclear or Clearstream or any other ICSD, well, there aren't that many, but a CSD, maybe it's actually more prolific than we think in terms of the auto borrowing programs that they run. Because I'm sure there's lots and lots of transactions that happen overnight for very short periods in very tiny amounts. But they would know more about that because they're seeing the system as a whole for those securities. So I think that's probably where we stand. I mean, I remember using the auto borrowing facilities at Euroclear for many years, and it saved us from huge fails. And it was expensive, but it was only relatively expensive to the fail cost at a 5% interest rate environment that we suffered from at the time. So they are using a facility, a utility rather, that is actually enabling the market to be efficient. And that will become more important as we enter into CSDR.
Yeah, so my first trade in London of a stock loan was 35 shares of a stock called Bowater, which I think was worth $500. And it was all about settlement efficiency. And that stayed out, as far as I know, for about 3 years. But look, you talked about the Jurassic period. Let me just share with you something that someone shared with me earlier this week.
Was that last week?
That's I wish that was last week. But interesting, I don't have that much less hair. But there you go. Beard's a little bit longer and whiter. Paul, you talked about the liquidity. And I think the interesting thing about sort of the day-to-day trading activity, would I be right in saying that the liquidity and sort of the market trading impact is actually by volume the highest contributor to activity, but the one that gets probably the least notoriety?
Yeah, I think so. I think so, Roy. If you just look at the again volumes in the primary markets, and particularly as you get outside of the large caps in equities and maybe some of the corporate bonds, you can just actually see from the Sec Finance data, you can see from the primary data that without there being willing lenders, some of these issues would be very, very highly illiquid. I mean, truly highly liquid, and so yeah, the volumes that get transacted are not insurmountable. And let's just add, all right, we've currently got in our data set, I think a number of about 3.1, maybe 3.2 trillion dollars of securities are on loan. Okay, it's difficult to tell of that volume how much is to facilitate FALS coverage, but I'm going to guess less than 5%. Okay, less than 5%. If you actually look at the volume in securities where you could probably think that somebody is taking a short position, okay, again, I don't think that volume is probably more than 20%, right? There are so many other reasons: financing, the access to high quality liquid assets, collateral. There are so many reasons that securities are being borrowed, and it isn't always to facilitate that, to facilitate a short, which I think when you traditionally get some of these debates about short selling, I know the Sec Finance or lending industry tries to distance itself a little bit, and I can see why that would be the case.
Yeah, Paul, you're absolutely right in that shorting and Sec lending isn't a one-for-one match and never has been, and yet I think it gets lumped in at the same especially when there's a negative piece on it, it gets lumped into the same. A good example actually was when after Deliveroo's disastrous IPO, the FT did a piece on it, and they used your data. And they said, well, here, this proves that it wasn't short sellers that drove the price down, because IHS Markit has only this modest amount on loan. And they immediately equated that with short selling, which is, in this case, it was fine to prove because it was a very tiny number. So I think that's always a risk, when the reality, as you say, that a number of times that you lend a security, it's nothing to do with short selling.
No, and look, I'll give you another example, John. I think this was actually published somewhere. A few years back, there was a Scandinavian or Nordic-based bank that had run subject to some bad anti-money laundering practices, okay? And there was a day or a short period of time where the share price plummeted, I'm going to say somewhere 30 to 40%. And naturally, CEO comes out, says, oh, it's the short sellers. You went and looked at the data, and in fact, you could see from our data set that it was the long holders that actually sold out of their positions. And on a peer comparison of looking at all Nordic banks, this particular bank had the lowest level of short interest at about 1.8%, I think it was, of their free float equity was being shorted. So in other words, when you actually looked at the data points that were available, it was really, really clear. This was not a short selling event. This was long holders expressing their view that they wanted to sell out their positions. But again, what comes out? Short sellers.
That brings me to a really interesting thing that I've been challenging people about for a long time. And I think you've both referred to research now. And I've always put it out there, and I'm genuinely interested in getting contrary views. I really don't want to just hear people that agree with me, although they obviously are right. But I've spent like 40 years trying to craft a view on this, and all of the evidence, right? All of the academic research every time comes out and says short selling bans and short selling in general actually makes markets better, lowers spreads, improves liquidity, all the things that we've actually talked about. Where the academic research is that identifies that it's actually a bad thing. And I've seen for the first time something that actually suggested that once a market has crashed, short sellers don't contribute any value to a market. But that's one, and there's so many things to challenge that one. But have you guys ever come across research that actually says no, short selling is clearly a bad thing generically?
I can say the short answer, Roy, no. Actually, the opposite on every occasion.
Yeah,
and I think that's because they're actually doing the work. They're actually bothering to find out. It's so easy when these temporary bans last year in the European markets. I kind of have some sympathy, but not empathy for them, in that they also have a political framework in which to operate. And maybe retail people or people in the street just associate falling markets with short sellers, and therefore they're not going to facilitate it. Although, having said that, the UK and the US didn't do anything. But I've never come across academic research. Back in my day when I actually worked for Paul's organization, there's a lot of academics that wanted to buy the data. And if you ever read some of the findings of that, and it was really interesting reading, and it was long, but they all came to roughly the same conclusions. And sometimes it was very specific about sectors, etc. But I don't think any academics ever come out banging the desk to prove the point.
Yeah, and John, that research is available for anybody to download from our website. Hopefully, Roy, I'm not digressing too much here. But John, you made quite an interesting point in your introduction around some of these new frontier markets are, setting up their ability for short selling and securities lending in perhaps more of a structured way. Okay, I think that if I think about the GameStop event, I think one of the issues that people are struggling to comprehend, and quite frankly, I understand why. How is it possible that you could only buy up to 100% of a company, but yet you could short more than 100% of the market cap of a company, right? And I think in many of these emerging markets, Roy, John, you mentioned Saudi Arabia's put a cap on maybe 20%. I think in Taiwan, there's a cap of 30%, all right? And I think that one of the things that where something probably needs to be looked at, and it's not an easy answer without the use of a CSD of some description to control all the transaction flow, is, to me, even the concept of there being a bigger short than there is market cap of the company just doesn't feel right, does it? Right, and maybe it's just worth me spending 1 second to explain to all of the audience today how that can happen. So let's say that Roy owns 100 shares of company A, and that's the only shares that exists. Roy decides to lend them to John. Okay, John then shorts them. Okay, but by short them, he's selling them, and he sells them to me. I then decide to lend that stock and sell and lend them to somebody else who decides to short. So effectively, you get that accumulation effect of a chain where people are selling, are then relending the stock. So that's how it can happen. So I do think that's one area that definitely needs to be looked at in perhaps more of the maturer markets or developed markets. Is, as I said, intuitively doesn't feel right that you could short more than the market cap of a company.
Yeah, and look, a couple of things. First of all, we have some more people that have put their location in from the audience. So Oliver's added that exotic location, which I have no idea whether it's in the UK or not, but it's West Malling.
It's in Kent.
Yeah, sure it is. That's what they say, but it could very well be an island in the South Pacific. David from Australia has not only said hello, but he's also added in sort of as a reinforcement about the lack of price discovery in Australia when the short selling ban was actually put in place. So that's both of those things are quite useful.
And actually, Roy, Australia is a really good example of a country with a persistent view on short selling, and it's still going on today. There's actually a paper that I don't think I brought with me, but which basically is a legislation that they want to put in front of Parliament that says you absolutely must ban all securities lending right now. None of the super funds should ever be able to lend their stock, etc. And he gives reasons why. They're not exactly accurate, but let's not dwell on that. But Australia has always had a persistently bad negative view about short selling, going back to 2008, and I suspect it came out of some of the financial scandals that were going on at the time as well.
Well, I can give you some history before the financial crisis. So they've always been skeptical, but because Australia is a big, sophisticated market with lots of derivatives, and Australians really populated and helped inform the derivative markets through much of Asia, it's kind of been a necessary evil. And John, just a quick point. Sorry, Paul. Thanks for that explanation on the GameStop. How do you get beyond 100%? Because I have to say, we have a video of that, of an explanation, just an animation of how you can get to exactly that position, the way you described it. It's on our YouTube channel. And I have to say, that's been one of the more popular videos because people just don't get it. And it's a reasonable question. It is an entirely reasonable question. Look, guys, you both touched on something here. And I did last week a survey on LinkedIn, or a poll, where I was saying, short selling, is it good because of all the things you've talked about? Is it bad because it distorts market? Were people uncertain? And there's also a category, what is short selling? And I have to tell you, obviously, the people that are linked to me, connected to me, and followers of me are likely to be a little bit self-selecting. So they're going to be more supportive, I imagine, than the average audience. But look, there were sophisticated, knowledgeable people that I consider to be experts in their field who were anti-short selling. And these are not, this is not, the stereotypical taxi driver who says, no, I bought Deliveroo and it went down and it was those terrible short sellers. These are informed people. Why do you think that we're still in this situation? Well, why do people, and you've been talking to customers that are lending or not lending or stopped lending, or, you've been talking to people about this for ages. What kind of anti short selling commentary do you think means a lot, like is actually reasonable, even if you disagree with it?
Yeah, look, it's a great question, Roy. And I think if I knew the answer to that, probably would be doing something entirely different, quite honestly. Look, I think, right, is that that for some reason, hedge funds who tend to be, have a bit of a reputation, possibly wrongly. Sometimes there are going to be examples, maybe correctly. They tend to be perhaps aggressive investors, okay, and there is this. There just seems to be this undercurrent of negativity around, hedge funds, all right, and what they do, and I do think it's it's kind of, I always think if you put a group of pro short sellers and anti short sellers in the same room, they would never ever agree. I mean, it just seems to be one of those things, like your favorite football team or religion. Sometimes you just can't get people to agree, right? And of course, the only way that we're ever going to know is if there was no short selling possible. We would then know what the world looked like, right? But I just don't think that would be really, really good, right? Where this was something I mentioned to you earlier, right? There have been examples of short sellers that short stock and then tell everybody that the company that they've just shorted is a terrible company, right? Somebody needs to explain to me why that is different from a long-only asset manager buying into his favorite stock and saying this stock company is a fantastic stock, it's a well-managed company, it's got all its ESG in line, this is a massive growth stock, right? There is no difference between those two statements in my mind. The one saying this company's terrible, one saying the company is is fantastic.
I guess the only difference, Paul, would be as if the short seller was using fraudulent language in slagging off the company, as it were.
Agreed. I completely agree with that, right? I just, I guess maybe from a purist perspective is having harmony between disclosure and what you can say to the long side to what you can do on the short side would be sensible to me. So, there's, in many of the major markets, there's mandatory disclosure of short positions more than, I think in Europe at the moment it's more than 0.1% of the market cap, which is the same as the long, all right? But ultimately, do you get to a point where you ban anybody saying anything about a company where you have an interest in it? Right? I mean, that's
I think you've touched on the point. It's the asymmetry of it that is the issue, right? I think some of the bad reputation comes in from people that produce reports. This is a bad company, and then when the stock inevitably takes a drop, they cover their position right away. So they're not really fundamentally in it about changing it. It's a short-term opportunistic pitch, and that's why they get a bad reputation. And it's less visible when someone does the opposite on the long side, where someone does a pump and then dump, right? Where they're actually talking it up and then closing out their long position after it's risen.
Yeah, look, Roy, I mean, what's our favorite, short of the last few years is probably Tesla. And I think that Tesla is a fantastic case study, right? Tesla, where we all know there was an enormous short, there was significant levels of income generated by the lenders on the back of that short. The long guys probably went in and had a nice cup of coffee with Elon Musk, and he probably sent them on the way. The short sellers kept on doubling up, and ultimately, Tesla made, corporate changes at the board level, production changes, so forth, right? And now its share price has accelerated away, right? And you could argue that the short sellers have been really, really fundamental in terms of some of the change that's there, and the long holders have benefited. Have benefited both ways.
They've benefited the most, right? And I made this point to someone last week. The Tesla long holders that have been in it and been lending have been the real winners, because they've had all the price appreciation plus the fees when it was trading special and when it's trading GC. So I think that's a great point.
Yeah, and
so, go ahead.
Yeah, and so one last
then.
One comment is a long investor only has at risk the price that he's paid for a security. Okay. A short investor has unlimited potential losses, because there is no distance a stock can't appreciate. A depreciation can only go down to zero. So actually the level of risk that a short seller takes on can be significantly materially different to that of a long investor.
Yeah, I think that's a great point. And,
so,
and also pretty relevant to GameStop. John, yeah.
So if I have a stab at your original question as to why do we think this vilification exists, I think it's fundamentally more of a human issue, in that, long investors, investors are trying to invest in a company that's going to do well. They hope it will do well. It's good for the employees. It's good for the dividend, which they then invest or reinvest. And therefore they're creating wealth and retirement plans. And it's a positive outlook on a company. I think when you flip that on its head, there's just a natural inclination that you're a negative person, perhaps, or you take a negative view. Whereas actually, stock investing should be completely neutral. There should be, all the emotion should be taken out of it to some extent. And don't tell me that you can express a negative view in a company without shorting it very, very easily. And so I think it maybe come down to some of those fundamentals, in that they're just looked at as a group of individuals that are somewhat negative. But I will say, to Paul's point, if you look at the research that Muddy Waters puts out, if you look at the language they use in when they are going short, what they say about the company, they would be sued from here to kingdom come if any aspect of that was inaccurate or could be proved to be so, and they wouldn't do it. And Paul's right. It's so much harder to be short at every level of the duration that your short is on. It costs you money. You could be wrong, and you could be wrong forever. And going back to GameStop didn't only happen because of short sellers. It wouldn't have happened otherwise. We'd never heard about it.
Okay, so let's move on to that. The only comment I'll make about the lawsuits is that Andrew Left from Citron wears his legal challenges on his sleeves as a badge of honor, to say, look, I've been challenged many times, and I did a podcast with Fraser Paring, who is one of the guys behind Wirecard Uncovery, who said that he's going to use legal cases as another line of profit and loss. So who knows? But look, we two things. One is, I'm going to go on to GameStop in a second, but Morris Leo, one of our regular watchers, has joined late. He's asked a question, which Paul, I want to come to you with this one, because it seems to me something that James Clooney, who we've had as a guest in various things before, has talked about, and that is what can beneficial owners and investors do by getting the short selling data, and whether they're short sellers or not, and adding that into their investment analysis of companies that they buy into. Do you see customers doing that with your data, and if so, how do they apply that?
Yeah, it's a great question, and a great intro, Morris. So thank you, and hope all's well with you and your family, Morris. So both in a prior life, when I worked at an agent lender, we would often talk to some of the PMs and trading desks about the value that is in their stock loan activity, in addition to the value that they derive from the stock loan activity itself. now that I work in a data orientated position, this is pretty fundamental to so many of the stuff that we are looking at, because we've got data on, what's short. We've got a pretty decent way of filtering out, what we think is short data versus just, transactional data that could be in the data. We've obviously got data about long holders on aggregate. We've now got credit-related data, and I know you had Mark Faulkner on fairly recently. And these are all data points which I don't necessarily think will drive and be a primary source of an investment decision for a beneficial owner, but would be are considered to be, in my view, and from what we hear from our customers, really important inputs to help understanding what is going on in a particular stock. All right. I mean, if the share price is falling, is it because there's a deterioration in credit? Is it because there's a short guy, or are the long guys selling? I mean, they are three fundamental points that are fairly widely available, all of which may lead you to take a different type of action, but nevertheless are really, really valuable, right? And also looking, particularly as we get into more active voting, looking at the data about how difficult it will be to recall, or other, it's so important. So yes, so to the point is, we do find, that many of the beneficial owners and long investors are really interested in the data. Probably not enough, Roy, in all honesty. It probably is like all things. There's very, very sophisticated end, kind of understand it, kind of already use it. But I wouldn't say that, every fund manager on the planet is actively using these data points.
Yeah, so thanks for that, Paul, and that would be my own experience as well. But look, I think one of the subjects we will be covering in whether it's in podcasts or on this, it kind of combines things that you and John both said. One is John mentioned about the emotion and sort of the human element of that, and Paul, you were talking about not everyone making use of data. I think both of those things are shocking, that you can actually have a human bias on top of things that isn't informed by data. But as I said, that's a topic for another day. I'm going to throw out something. So thanks, Morris, for that question. Can I first say to everyone in the audience, one thing we never do here, we haven't done yet. If you like what you hear from today's event or previous events, can you just give us a like? It will help make certain that we reach a wider audience in future. So if I can be so bold as to ask you to like it if you feel that way. But now, having asked that, I'm now going to say something controversial here. So look, GameStop, Paul talked about more than 100% of the free float being shorted. And so I've said for a long time that I think it was overtraded by Melvin Capital and others, but they're the famous name. I want to also say and put out there and see what people think. I think this was overlent. If I'm lending out a stock and I know that my client can sell it at any point in time, I'm going to have an eye on the amount of unborrowed assets there are, so that if my client sells it, can that be substituted with another one of my own clients or from the market? So I think that these two things kind of go hand in hand. Happy to be told that I'm wrong.
Yeah, Roy, can I just make this? We've spent a lot of time, and Sam Pearson in my team has put out a lot of what I think is quite insightful information on GameStop. One thing that is generally or not known is that I think in the November timeframe or December, GameStop bought back 25% of its entire market cap. Okay, so overnight, short interest effectively went up by 25% in GameStop, because 25% of the free capital or free equity of the company got withdrawn from the market. And that was the first trigger point that happened. You went from a point where there was, a 10% short to suddenly there being almost a 35-40% short, simply because of a piece of corporate activity. It's also arguable that GameStop would never have been able to buy its own stock back, right, if it hadn't been able to, the brokers hadn't been able to borrow the stock for them to buy it back. So there was, as I said, a number of things in there that are a little bit misunderstood. But your point about being overlent is also true. The other issue that is, again, not often talked about is the use of options. So my understanding also is there was quite a high volume of very, very deep out-of-the-money call options that were purchased on GameStop. And as the share price started to rise, the sellers of the call options are forced to guess to do what? Buy the stock. So actually, it has the inverse impact of, or it has the impact of actually driving the share price actually higher. And again, whilst I'm not, whether it's overlent, I'll let other people do it. You had these two things going on simultaneously, in addition to the Reddit traders, taking, buying more of the stock as well.
Right. So, John, I'll let you in a second. I just want to say, Paul, I think you've hit on a really critical point. So the options related gamma squeeze, I think, is something that really has, it's been around forever, but it's never really come to the fore. It's never been that obvious. And look, the perfect evidence of that is, I think, that the Options Clearing Corp in Q1 had record levels. Right. And that just proves the case for option activity related to the meme stocks. And as you said, that buyback previous to that, and then the gamma squeeze, the reality is that put extra pressure on the liquidity aspect of borrowing and lending in the markets as well. So fundamentally, you can't just unpick one of these things and say this was overlent or this was overtraded. It was really that sort of confluence of events, I think, that created the situation.
Out of interest, Paul, do you know that the highest utilization that it got to?
Off the top of my head, I don't, John. I would say two things. We have in our product a short squeeze model, and it looked at a lot of data from both the primary markets and the secondary markets. And from beginning of early November, it was predicting a short squeeze in GameStop and AMC and some of those other stocks, right? So in other words, we're going back, I know this is seems like it's self-serving. In other words, if people had looked, the data was all out there that was predicting fundamentally that these events would have happened. And to Roy's point, the reason we have a short squeeze predictive model is so that preemptively people could withdraw their securities in a more controlled way from the securities lending market, rather than the frenzy that tended to take place, right? So again, the sense is that a lot of these, I'm not going to say alarm bells, but a lot of these points were easily out there for anybody to look at.
And the only other thing I'd add in there is our colleague Jerome Tucker in his blog post in October actually pointed out that short sellers in GameStop should actually be considering their position at that stage. So look, Preston, really, I still am amazed that he called that. But again, it's I don't want to go off on a weird tangent, but it's like the housing crisis in the U.S., right? The subprime mortgage market actually peaked 2 years before the market recognized the crash. So there's always signs out there, and I think that's one of the reasons why we want to come back to this whole idea of being more data driven, because if you're actually embracing data more completely, more comprehensively, then it's easier to find potential problems, issues, and opportunities.
Yeah, agreed.
No, I asked about the utilization, Paul, because back in the days when I used to lend securities, at a certain point, at a certain utilization, with new supply, I'd have been very reluctant to lend it into that, because the ability to get it back would have been compromised to some extent. And the last thing I ever want is a client who, once that peak has reached, who wants to sell into that. I don't want to fail to him. So it's particularly true of corporate debt, more so perhaps than equity, but it is, as you say, it's telling you something. There's a signal here, and you need to react to it from both sides of that fence. And lending into something that you have no hope of, it's probably going to fail. If you try and get it back, it's going to be interesting.
We had a client at my last firm where we had to monitor the available positions relative to their individual holdings. So you can imagine it's a large client, and it was an automated process to actually say, someone's pulled the stock from the market, so it's no longer available, or um, you know, someone sold their position, whatever it was, whatever affected the unborrowed available shares would have an impact on how much we could loan, and we had to automatically start recalling if the client's position and their tradable position represented too much of the free float.
Yeah, right. With some of the oversight reporting and tools that we provide beneficial owners, some of that data is around what's their current market share in terms of the on-loan position, how much of the company is being shorted, right? And we work with our clients to them set what their limits are. I don't want to be more than 10% of the on loan, and we also measure how long we think it will take to recall, right? Particularly if there's a vote coming up, can you recall that in 1 day or in 50 days? So again, we found those pre-GameStop and post-GameStop to be really, really important points that we're finding many beneficial owners are really, really interested in using.
Okay, if anyone has any questions, we got 7 minutes left to go. John, did you want to add anything?
Yeah, can I sabotage a question that you may be about to ask us? So obviously, GameStop was largely about retail investors. If I read the press and believe what I read, they just had it in for hedge funds, and they were going to punish them. Do you guys think that retail investors should have equal opportunity to short securities the way that institutional investors do?
Paul, if you want to go first, I have really strong views on this. So surprisingly enough.
And let me just, sorry, Paul, let me just caveat that. I mean, you've noticed, you've probably read that South Korea is going to allow it to some extent if you pass some kind of knowledge-based exam that you know what you're doing, which I think is kind of interesting.
Look, it's definitely a moral hazard question for me. On the one hand, I really believe in free markets. I believe that access should be open for all, okay, with the minimum level of constraint, right? Everybody should abide by the rules. But with retail investors, you do wonder whether sometimes you've got to protect them from themselves, okay? And we've seen, how many retail financial scandals around the world, and I definitely think there is some, in my view, some need to protect some retail investors from themselves, right? But I'm not going to be a hypocrite. I think they need to be protected for themselves as much to the long side as they are to the short side, right? I think it should work both ways.
Okay, so and that all makes a lot of sense to me, Paul. Look, my issue though is, again, it's this question of asymmetry. So I spend a lot of time on Clubhouse, and there's some very interesting discussions going on there. And I have to tell you, I have listened to and engaged with some really sophisticated individual retail customers, right? Number one. I have also heard on those same things where people in the audience are asking questions about the options that they've traded, and they aren't certain whether they've sold the option or bought the option, right? And they aren't always clear about whether they've bought a put or a call, right? And so it runs within the retail investor the full gamut. But to me, as long as they can continue to buy and sell options, and as long as they can continue to buy and sell inverse ETFs, leveraged ETFs, right? I don't understand why an investor can do that, an inverse leveraged ETF on the short side, and not be able to short the stock directly, because obviously the leverage magnifies that. So either have something that says no leverage, no optionality, plain vanilla unless you pass the test, which as I recall in Canada, before I did options trading as a retail investor, I had to pass something for my broker, before they'd let me trade them. But whatever. So either you do it that way, and every leverage product has to be that way, or none do, right? And John, I'll go back to the other point. I've been arguing that GameStop has always been mischaracterized as David versus Goliath. Hedge funds had massive long positions in it before this sort of kicked off, and I'm pretty certain that hedge funds made money on the long side and short side throughout the first quarter. And the size of some of the option positions means that it was institutional. So I think David versus Goliath is a great convenient story for media coverage, but I don't buy it. Obviously, there was huge participation and it was high profile, but volumes, I think, were largely driven elsewhere. But I could be wrong. I could be wrong. Listen, guys, we're coming up to the hour, so I'm just wondering, because this has gone so fast. There's so many things I want to talk about, which we didn't. I'm just going to make a quick pitch for the pack. So these sorts of discussions, like long short strategies, like pledge collateral, like yesterday where we talked about tax arbitrage and the CumX, that's all part of the Pierpoint Alpha community, where the members get access to experts talking about that. So have a look at the pack if you get a chance. Paul, maybe just give me sort of closing thoughts on sort of short selling, GameStop, any of the aspects to it. Just whatever.
Yeah, really quickly, Roy. I think you're absolutely right. I think there's still a lot of mischaracterization of what went on. Okay, and I think in some ways you've got to look at all of those aspects. I do think there are some lessons to be learned. I mean, I've talked about the need for it just doesn't feel like to be able to short more than the market cap. I do think the US has been a bit slow with the implementation that was recommended by the Financial Stability Board back in 2009 of some better oversight of securities lending and short selling. I think it would be relatively easy for them to adopt an SFTR-like regime, because for most of the counterparties who are already involved, flip a switch. So I do think there are a couple of things that can come out of this, which I think would be really positive, and start to I think hopefully will chisel away, all right, the sort of some of the negative perception that naturally flows from these events.
Yeah, great points, Paul. Thanks for that, John.
Sorry, was there a question there?
No, just closing thoughts or.
The thing I was going to say is, in closing, Paul's decision, for example, to buy HSBC and my decision to short it hasn't changed the fundamentals of HSBC one iota. And everything goes from there. So you have to look at this as how is it I'm the villain and Paul isn't?
Again,
John, don't go there, John.
That's a great conversation. I made exactly the point to a journalist last week about a commentary from a junior mining CEO listed in Canada.